special webinar we have here today at Advanta. We've brought a guest in from a crowdfunding portal company, Early Shares, and bringing them in to talk a little bit more specifically about a little bit about crowdfunding, what's new, and also what you need to know about investing in private offerings. For anyone who's listening live to this call, if you have questions during the webinar, please type them into the chat box on your screen. We'll be happy to answer those questions as we move along. If you're listening to a recording of this webinar call today, just jot your questions down. My contact information and the contact information for Heather Lopes will be at the end of the presentation, so you can certainly contact either one of us with any questions that you have. My name is Scott Maurer. I'm the Education and Marketing Director for Advanta IRA. I've been with the company for a number of years now. I'm also a licensed attorney, although I don't do any legal work for Advanta clients. I focus primarily just on the education and marketing side of our business, either hosting webinars like the one you're listening to today, or perhaps doing some live seminars and networking events as well, kind of just to spread the word on self-directed IRAs. Just a little bit about our company. We've been around since 2004. The only thing we do is administer self-directed retirement funds, basically qualified money. So if you have funds in an IRA, Roth IRA, old 401k, that's something we can certainly handle, and you instruct us with what it is that you want to invest into. We are not a broker or a bank, so we don't invest in mutual funds or stocks, more conventional type assets, but a lot of the different things and some of the things that fit into the category of what we're going to talk about today. Just a quick disclaimer on Advanta and what we do and what we don't do. We provide a record-keeping and custodial service for the alternative investments within an IRA. We do not provide investment advice, so we don't endorse any particular products or investments as well for our clients. We provide webinars that we're doing today as an educational event and a learning experience for our clients and for others who are logging onto the call, for people to get a better idea of what it is about self-directed IRAs. If you have legal questions or tax questions, or especially a question on due diligence or whether or not to make an investment, that is a situation where you would talk to a CPA, to an attorney, or potentially your financial advisor before getting into that type of an investment. We can always provide you with referrals to those individuals as needed as well. Very quickly, why haven't individuals heard about self-directed IRAs? I think the most common reason is that most retirement accounts are held with banks and brokerage firms who probably makes up 95% of the retirement accounts that are in existence. So most individuals have their monies within a company like a Charles Schwab or a Fidelity, where their investment options are limited to what Schwab or Fidelity will allow you to invest in. But IRS regulations do allow for a much broader range of investment opportunities, whether it's real estate, private notes and mortgages, tax liens, tax deeds, or private offerings that we'll talk about today. Those can all be held within a self-directed IRA account. You just have to have the right custodian who's willing to hold the asset. Again, most banks and brokerage firms are only interested in offering you the products that they sell and that they administer, but IRS regulations do allow for this broader range of investment opportunities. In fact, the IRS, when they wrote the rules for IRA investing, said the only two things you cannot do within an IRA account are you can't purchase life insurance and you can't purchase collectibles. And collectibles would include your antiques, artwork, stamps, things of that nature. And the other restriction the IRS placed on investments within an IRA is you also cannot have your IRA deal with any disqualified person. And a disqualified person would include yourself as the IRA owner, your spouse, your parents and grandparents, your kids and grandkids, or any business or entity that you own or control. So in the context of what we're going to talk about today, if you were forming a private investment fund and you are actually running the fund and being paid by the fund as a manager or president, your IRA is not going to be able to invest in your particular project. But if you were looking at investing into a private placement or a company with which somebody else who's not disqualified is running that business, your IRA could potentially make an investment into that LLC, into that corporation, and hold an equity position there. Now again, today we're talking about private placements. Private placements really look and feel a lot like assets that you would be more accustomed to seeing within an IRA account. Publicly traded stock, for instance, people buy stock in IBM, Coca-Cola, Disney. they're basically buying, again, an equity position or an investment into that particular publicly traded company. Obviously, that could be done through an E-Trade account or a Scottrade, more familiar custodians like that. But a private placement is something very similar, where you have a private business that is looking to raise capital and is maybe willing to issue shares or issue equity within the company, but only because that investment is private. That's why a company like a Schwab or a Fidelity is not willing to hold that type of an investment. Again, IRS regulations do not prohibit it, but those bigger custodians have decided simply that they are not willing to hold it because the asset is private. Now, they have their various reasons why they don't hold private placements. Some of that has to do with not wanting to sell anything or allow anything to be held that they don't sell or administer. But again, the private placements can take a number of different forms. It could be a private stock in a corporation, a private LLC, perhaps a private trust, or crowdfunding, which is something that's relatively new. And at this point, I'm going to turn over the presentation to Heather Schwartz-Lopes, who's going to talk to us more about investing in private placements. Heather is the co-founder and CSO of earlyshares.com. Heather joined us a few months ago and talked a little bit about crowdfunding in general. I think she might cover a little bit of that again today. But focusing more today on private placements, what has led to this new crowdfunding opportunity, what is crowdfunding, and who can invest in private offerings. And I think she's going to talk a little bit as well about the due diligence that goes along with making an investment into a private placement. Heather, are you there?
Yeah, I'm here.
Great. Well, Heather, I'm going to turn it over to you and let you inform us all a little bit more about the crowdfunding and the private placements. And again, anyone who has a question during the presentation for either Heather or myself, please type it into the chat box on your screen, and we'll make sure to get that question answered. But Heather, it's all yours.
Great. Thank you so much, Scott, for that wonderful introduction. Thank you for having me and letting me speak along with you about this really exciting thing that's going on within the crowdfunding space. And actually, this has been going on and gaining a lot of traction over the past 3 years when we originally founded Early Shares. And so really what Early Shares is, we are an online equity crowdfunding platform where we are facilitating private placements and creating a new private investing and private placement marketplace for accredited investors to invest in growth companies, real estate opportunities, and private funds in a way that they've never been able to access before. And so with new regulations, which a lot of people have heard about, the Jobs Act, this has created an amazing opportunity for investors to seek interesting and unique and alternative investments, and also for entrepreneurs and project owners to seek additional funding. And so I have a long history in financial services. I've worked for big banks, big financial institutions, and myself and my co-founders, we just got very frustrated with the way that this type of business was traditionally done. I have a lot of experience working in private banking and helping my clients who were mainly comprised of entrepreneurs and real estate principals and sponsors. And I found how difficult it was for the banks to lend to them. And these are clients with millions of dollars in relationship with the bank, and it was just very difficult with all of the regulation and all of the constraints and underwriting. And so looking at what was coming down the line, looking at the Jobs Act, it just presented a huge opportunity. And so over the past few years, we've built Early Shares as a platform to make the capital raising process a lot more efficient, to create education among this new industry. We've worked very closely with the Securities and Exchange Commission and FINRA and helping address a lot of their concerns and their issues with this new marketplace. And so we're very excited to see how this business has grown and developed. And honestly, we're in the very first inning of the opening season, so there's a lot more to come. So let's just start really quick. We'll talk a little bit about what is private investing. Scott mentioned earlier that these are really companies that are not registered and publicly traded like your Coca-Cola or GE. So when we look at securities offerings, we've got 3 types of securities. You've got registered securities like your Coca-Cola and Merrill Lynch. You've got exempt securities, and then you've got illegal securities. So we definitely focus on the exempt securities here at Early Shares, not publicly traded, and more specifically looking at the exemption known as Regulation D and 506. We look at 506B and 506C. 506B is the way that private placements have been done traditionally over the past several decades. Billions of dollars are raised on an annual basis utilizing these exemptions, but historically it's been very quiet. As an entrepreneur or as a project sponsor, you were not allowed to raise money in exchange for equity in your company publicly. You weren't allowed to even mention out in public that you were doing this until the offering was closed. So you had to be very careful what you said on social media, very careful what you said in the press, but now all of that has changed. So with these new regulations and with a lot of technology, we are really opening up and broadening this new market. So I'm just going to talk really quickly about the Jobs Act. So the Jobs Act stands for Jumpstart Our Business Startups Act, and it was passed and signed into law in 2012. The SEC was tasked with coming out with the final rules and regulations, which has been a slow process, but understandably slow. It's complex regulation, and they need to be extremely careful how they design and how they roll out the rules. But the Jobs Act was put in place, and it had incredible bipartisan support to stimulate capital and provide easier pathways of capital for small businesses, which we all know small businesses fuel and create the majority of the jobs in our country, and it was designed to boost the economy. So the Jobs Act has 7 titles. We focus on 2 of the titles at Early Shares. Title II, which is in effect today, which is really applying general advertising, general solicitation, opening up this private placement market to accredited investors. And then Title III, which opens up this market to unaccredited investors. That is something that is not yet in effect. The SEC is still struggling and crafting the final rules and regulations around that, and I'll talk a little bit more detail in the upcoming slide. So looking a little bit more closely at Title II, again 506C, companies are allowed to leverage public forums and media and any type of advertising possible to broadcast, to create visibility, to create additional access and introductions to investors. The caveat is, even though you're allowed to solicit and publicly advertise to anyone, you can only accept investments from verified, accredited investors. The old way of doing business was simply a check the box. So an investor wanted to participate in your private placement, they self-certified and self-attested that they were an accredited investor, and that was it. Well, now that rule has changed. If you are using general solicitation, where investors now have to verify that they are accredited. So to be an accredited investor, you have to have at least $200,000 in individual income for the past 2 years, or $300,000 if you're married filing jointly, and you have to have that expectation to maintain that level of income in the upcoming future. Or it's not an and test, it's an or test. You have to have $1 million in net worth, and that's excluding your primary residence. So there are several ways that you can verify this accreditation. The easiest way is to get a letter from your investment advisor, your broker-dealer, your CPA, or your attorney. We have also built a mechanism where we have plugged into the IRS, where we get a very simple report that just gives us a positive or a negative confirmation if you have met those 2 income thresholds. We definitely don't like to get a lot of personal information, so we try to make that as easy as possible. But there are a few other ways, and there's some grandfather provisions. But just to let you know, as an investor, that is something that you have to do that you're not probably accustomed to doing. So looking at Title III, again, not yet in effect, but this is true equity crowdfunding, where you can have hundreds or thousands of investors that can participate in an offering that do not have to be an accredited investor. So regardless of income, regardless of net worth, these individuals will be able to invest. The SEC has put in some restrictions on how much you can invest on any given year. And they've also put some restrictions if you're a company raising money, how much that you can raise. So you're limited to raising $1 million in any given 12 months. You are also, as a company, forced to use an online funding platform or an intermediary. So if you're looking to, just to jump back really quick, if you're looking to raise money utilizing the regulations today publicly, you can actually do so on your own website. But if you are looking to offer those investments to the crowd when Title III goes into effect, you must do so on an intermediary that is registered with FINRA. So there's a lot of other rules and regulations. The proposed rules that came out last year were 685 pages. Not sure how many people on the call has had the opportunity to read that, but it's quite complex. I've read it a couple of times, so it's going to be interesting to see how everything shakes out, and we expect those rules to come out sometime next year. So let's take a look at some of these market trends. And this is really important to see why we believe that this is going to be a really important market. What we're doing is capitalizing on these trends. We're reducing costs. We're increasing efficiency by simply allocating capital by replacing expensive intermediaries with online platforms. We've seen it in other spaces in the peer-to-peer lending space, such as Lending Club and Prosper. They've done $6.2 billion in loans. So the banks are paying really close attention to this because what people are doing is individual borrowers and commercial borrowers are going directly to a crowd of investors and lenders, and they are cutting out the banks completely. So you're seeing that this has become incredibly popular. We've obviously seen a huge trend in going from traditional financial advisors and traditional broker-dealers to more of that self-directed, I'm taking over, I'm taking control of my investments. So we've seen a huge shift in that market. And then looking at another area of crowdfunding, looking at a company called Kickstarter. So what they're doing is a peer-to-peer product and reward-based crowdfunding. So if you are a designer or a musician or an artist and you're looking to pre-sell your tour or your band, or if you've got this really cool invention and you need some seed capital but you don't want to give up equity, you can give up a product instead. That's becoming very popular, and we've seen products on Kickstarter that have been funded in excess of $2, $3, $5, $10 million. So that's been a great benefit for those entrepreneurs. They pre-sale, they don't have to give up equity, and it's created that validation that they needed. So we're seeing a lot of disruption in online funding marketplaces, and we firmly believe that the equity crowdfunding and the equity private placements, that we're going to see that same trend. So why is it so important? Well, capital is really difficult to find. If you look at these statistics and you are raising money for your company, I mean, these are some daunting figures. It's no surprise that banks are still very restricted and have a lot of compliance and constraints on how they're lending. And so this is why this legislation is so important and so critical, that opens up this access point so funds can flow more freely. Now, it's our premise that we believe that accredited investors, they haven't invested in these private placements historically. Looking at the numbers, only 3% of accredited investors participate in private deals. Well, that's because they've never had a marketplace to access these investment opportunities. So when you look at the money that is sitting on the sidelines in personal savings, $33 trillion with close to 9 million accredited investors, that obviously presents a really nice opportunity in this space. And so it's platforms like Early Shares that are helping to bridge that funding gap and just make the whole capital formation process a lot more seamless, efficient, and transparent. So there's several benefits to general solicitation in this new regulation. So there's investor benefits and there's issuer benefits. And really the overarching message here is access. Access to capital, access to new opportunities. So looking more specifically for investor benefits, it's pretty traditional in what kind of opportunities that you are allowed on platforms and traditional brokerage houses like a Merrill Lynch and an E-Trade. You've got your common type of asset classes, stocks, bonds, mutual funds, cash, not really attractive, not really interesting. Well, now on this new marketplace, you can access individual early stage companies that have some really unique and interesting opportunities and have an amazing ability for multiple growth, for a substantial growth. And what we're seeing is that companies are actually staying private longer to capitalize on that growth before they're going into doing an IPO. So that's where we see a lot of the opportunities happening. Obviously, there's a lot of transparency. So in the traditional way that private placements were done, they were really done on a one-on-one relationship. You shared your offering materials, your pitch deck and whatnot, but there was never a place where you can aggregate all of your offering materials, that you had clear visibility into what was being offered and to seeing everything aggregated in one place where you can access it at your convenience. So that's what these online platforms are creating, this really unique, nice digital deal room where investors can go in. They can see all of the related offering materials. They can see due diligence. They can see comments and questions from other investors. So it's more of a collaborative environment where you can analyze investment opportunities in a way that you've never had before. Security, that's obviously very important when you're dealing with private placements and investments. There's a lot of security features on our site. That's something that we keep a very close eye on. Variety, having a diverse selection of products. So on our platform, we've got real estate opportunities, individual real estate opportunities, private funds, and then individual growth companies. So you get to pick and choose what you would like to invest in. So just looking at it on the flip side, on the issuer side, we help our clients and we work with them very closely. We help them in a few different ways. Obviously, number one being access, which provides a lot of exposure, provides a lot more visibility into their raise. We help them with marketing and creating some attention in the media and the press. But we've also provided them with a very nice technology solution that just makes the process more efficient, where all of their offering materials are aggregated and delivered in a consistent way, where all of the subscription documents, the offering documents, can be signed electronically online, and copies of those fully executed documents can be housed online in your dashboard in your account. So those efficiencies obviously save time. But looking at the new regulations, it's complicated. People are still learning about it and getting comfortable with it, and we help our clients and provide guidance to both them and their securities attorneys and team in getting them comfortable with this. So there's a lot of options both on our platform, and there's several other platforms just to mention. With a big opportunity, a big market size, you're going to see a lot of competition in this space. Platforms vary between the type of products that they're offering and also the type of industries that they're specializing in. So study the platform, get comfortable with what they're doing. You're going to see some platforms are registered investment advisors, some are broker-dealers, some are just technology marketplaces. So take a closer look at that and get comfortable. Also get comfortable with their compliance and their due diligence, which I'll talk a little bit more about later. So we already discussed who can invest. I went through the accredited investor. Just to let you know, for the investors in the audience that are listening, you will have to verify. Just to further emphasize that point, it is no longer a check the box. You will be asked from the issuer or from the platform to provide some type of information or some type of supporting documentation to verify that you are indeed an accredited investor. Okay, So what you can invest in. Let's talk about private companies first. So we are seeing amongst the entire industry, we are seeing all different stages of companies and their business growth, all the way from startups, so pure idea that you've got the team, you don't have a lot of validation, it's just concept phase, all the way up to companies that are a lot more progressed in their stage that have gotten millions of dollars in funding from venture capitalists and angel investors that have significant validation through customers, through users, or through clients, and have the potential of doing a public offering in the future. So the range is pretty broad. Industries, you've got financial technology, consumer products, technology, entertainment, music. So the variety that you're seeing out there is pretty large. What's really important that when you invest, to get comfortable with the investment, the investment opportunity, read all of the materials online, ask a lot of questions offline. These entrepreneurs and these issuers are more than happy to have conversations with you one-on-one. Not everything has to be done online and through the platform. So another asset class that has actually gained a considerable amount of interest is real estate. And so it's really been the shining star, the unexpected shining star. And if you look at the statistics, real estate has outpaced any other industry 4 times to 1. We are seeing a variety of offerings, both structured as equity or private notes. And if you wanted to get into real estate historically, you had to do so either through a REIT, which you don't have a lot of visibility, you don't have a lot of control in what you select and what you invest in, or you had to buy the property outright. So if you're looking at a commercial opportunity, typically those cost $1 million plus, depending on the underlying asset. So this type of marketplace in private investing presents a very unique opportunity where you can invest in little pieces of an individual property or project. So for as little as $5,000, you can own a piece of a CVS, or you can own a piece of a 200-unit multifamily anywhere you like. So that's really nice that you can pick and choose. We're seeing several property types. You're seeing triple net opportunities, multifamily, industrial, warehouse, development, stabilized. So there's a wide variety there. And it's really no secret why real estate has been such a successful asset class and so popular. There's a lot of tangibility to it. There is clear expectations. You can see from the historical financials what the projections are going to be and have a lot of confidence that those are going to be the projections going forward or the actual numbers going forward. You've got underlying tenants. You've got contracts in place. And that ability to go and visit the site, which we've had some of our investors go and see the opportunities and the properties on our site, there's a lot of benefit there. And then lastly, what we're seeing is the fund market opening up. So hedge funds are leveraging these new securities regulations and opening up access to everyday investors, the everyday accredited investor. So typically these deals have been restricted to ultra high net worth investors with minimum ticket sizes of $5 million to invest in the fund, or institutions. And so we're starting to see this trend where funds are opening up at much lower price points to get into a hedge fund type strategy. Okay, so it's really important to understand what goes on behind bringing these offerings to a platform. And again, you're going to see a variety of the levels of vetting and selection between different platforms, and that's something else that you need to be comfortable with as an investor when working with a platform. But just to speak a little bit specific about our criteria, we primarily work with emerging growth companies in real estate. The number one thing that we look for in both of those industries is the team. So for growth companies, who is the team? What have they done before? Do they have unique experience, and do they have the capability of being able to execute on their idea? So if you're an attorney going into a pharmaceutical business, that's probably not a really good match. But if you are somebody that's been in the financial services business for the past 20, 25 years and you are developing a new financial technology company, that's a really good match. We also look for traction. So what has the company done in terms of building up their product base, in terms of building their user base, contracts, revenue. We work with companies both pre-revenue and post-revenue. And also, what is their unique value proposition? What problem are they solving, and what market are they addressing? Is that market big enough? What kind of competitors do they have? If you're a company that is competing with Facebook, that's a pretty big obstacle. But if you're a company that really there's not a lot of competition and there's a huge problem that needs to be solved, well, there's a really interesting market opportunity or investment opportunity there. We also look for proprietary technology or any kind of intellectual property such as copyrights and trademarks and patents. So on the real estate side, again, focus on the sponsor. We look for sponsors and real estate principals that have had experience for at least the past 10 years and have had experience within that asset class. So multifamily, doing a multifamily raise, we're comfortable with that. If you are a developer that you specialize in hotels and all of a sudden you're making a switch to multifamily, that's a big jump. There's a disconnect there. So we're looking for asset-specific experience. We're looking at the transactions that you've done, the historical returns. We are getting comfortable ourselves with the property types, making sure that we understand the structure of the deal and that it is something that we think presents an interesting opportunity for investors. And lastly, how much skin in the game does the principal have? How much sponsor equity are they putting in? We require at least 10% that they put in sponsor equity just to show that they believe in the project as well. So in addition to the vetting, which is a business component, we also look at due diligence, which is the legal and structural component. So we partner with a company called CrowdCheck, and they're based out of Washington, D.C., and it was founded by a former SEC attorney, Sarah Hanks, and she specifically focuses on working with private companies that are leveraging these new opportunities or these new regulations to do a public offering. So she is looking at the company itself, making sure that they are structured properly, making sure that all of their corporate filings are in place, that their raise is actually authorized from a corporate governance perspective. If they are claiming to have patents, she will go ahead and verify those patents or those trademarks. She'll check to see if there's any litigation pending with the company. She will check little things such as, do you own the website? Is that website registered to your company or to you? So a lot of things that she does, and I believe she checks something like 100 different things. All of those things may get overlooked by an unsophisticated investor. And so it's really important to ensure that all of those compliance and those legal checks are done. And what's really nice is that we are able to pull all of that information from what her research team does, pull it into our offering page on Early Shares, and it is shown and displayed in a really nice, easy to understand, easy to work with way. And she also has a lot of education that is part of the due diligence. So for every check that she does, she has a little why this matters button. So it tells the investors why this check was important, what we do. And so for everything that she verifies, she's able to append that supporting documentation right there on the website. So we're almost done. Just to wrap things up, what you get as a shareholder. So it depends on the deal structure. You've got direct equity, you've got convertible debt, you also see notes, you see LLCs and partnership agreements. So depending on the type of structure will depend on the type of documentation that you receive. But typically, you're going to get your subscription documents. You will get an executed copy either digitally or signed offline. If you're investing in an equity opportunity, then you're going to get stock certificates. And there's other privileges of ownership than just the profit potential. So we've seen some of the campaigns structured on our site as a combination between equity and also a reward. So in addition to being able to grow with the company as an investor, you're also able to get other discounts within that company. So that's been a really interesting way of early stage companies to give back to their investors pretty quickly. But everything will be online, so it's really nice that you can revert back and check your records. So pretty much that wraps it up as a summary of what private placement is. It's obviously a lot more detailed than that, and so I'm more than happy to answer any questions that you may have. Here's my contact information. We're based out of Miami, Florida. We do a lot of traveling, a lot of road shows. So I would love to hear from you, meet you, and get your comments. Thank you so much.
Thank you, Heather, for joining us. And if anyone's listening on the call currently has a question, please get it typed in. So just wanted to go. I had just a question or two. Actually, one just popped up, so I will ask that first before I get any of mine.
Okay,
the question
perfect.
comes in, says, I don't know how familiar you are with 1031 exchanges.
Yep,
Obviously,
exactly
this is not an IRA thing, but are there investment opportunities, or maybe some of the investments that are available through the portholes, are they eligible for 1031 exchange?
So, looking at a 1031 exchange, it's a whole exchange. I haven't seen any syndicated exchanges like that. That's something that we're looking at a little bit more closely, but I haven't seen it yet. Okay.
And a question, just kind of whether an IRA or even an individual was looking at making an investment. And just to clarify, if a client is investing and they look and see an investment opportunity on your website or on another platform, they're actually getting shares in that particular company, or are there other investments where it's actually going through someone, like early shares, where you're investing into an investment with early shares, and early shares is making the investment into the company? Maybe clarify kind of what scenarios either one of those opportunities would play out.
Yeah, absolutely. So actually it's both. So you're seeing, and we do both. So you see platforms that specifically offer direct opportunities. So as an investor, you become a shareholder or a note holder in that issuing company. You also see platforms that are structuring these SPVs, these special purpose vehicles, in the form of an LLC, where they are acting as an aggregator and an intermediary to pool together investment dollars, and then they in turn take that pooled amount and they make a single investment into the underlying company. So it's almost like investing in a fund, but that fund has already pre-selected the underlying investment. So you already know ahead of time that I will be ultimately a shareholder in that multifamily property or in that growth company, but I have to do so through this special purpose vehicle because that's serving as my access point.
All right. Another question came in, again related to the 1031 issue. The question is, how about a tenants in common investment for a 1031 exchange, like doing like a partial equity investor? Would that work, or you kind of the 1031s? I mean, maybe get into that. I don't know if you understand the question, or
yeah, I don't have a lot of experience in TICs. I understand they used to be very popular. They're less popular now. A lot of real estate investment is done through LLCs and LPs, or limited partnerships and limited liability companies. I'm not quite sure how a TIC would work for a 1031 exchange. I imagine, that's a really good question. I don't know.
Well, Rick, if you have to,
I'm not afraid to say I don't know.
That's okay. That's good. But I'll Rick on the call, if you just maybe get Heather's phone number off this slide and give her a call, maybe explain it in a little bit more detail and run through that
happy to
scenario.
have a conversation. Yes.
So just curious, a lot of clients that we have at Advanta here are real estate investors as well. So maybe more questions on the real estate side of things. But when you're dealing, I guess I'm assuming primarily with commercial at this point, correct? There's no residential.
Correct.
Okay.
We deal primarily with commercial. We also have a pool of single-family homes that are coming on the site pretty quickly. But you will see other platforms that specialize in the fix and flip on the individual single-family homes for investment purposes that are smaller raises. So I've seen platforms raising money for a $50,000 project, which is a fix and flip someplace, one of the states.
Okay.
So you see a huge variety. We've typically funded projects that have been more in the multifamily, in the retail space, in the strip center, where it's stabilized cash flow. Typical investment terms look like an 8 or a 9% preferred return, with an overall IRR at 12 plus. We also have a couple of development deals that are coming on the site pretty quickly. So there's a lot of new stuff. It's a constantly evolving and changing platform. So you've got to stay tuned and come back often.
Okay. With the real estate investments and the due diligence, obviously you mentioned the importance of having a team and looking at past a track record for that type of property to have it be a potential investment. Now, how much do you put any weight in the fact of maybe someone who has maybe doing too much? If you're looking into someone who's looking to have a property come on the site to raise money for, if you think that they're kind of almost extended too far in what they're doing, is that a factor? Obviously, you don't want somebody who's green and has never done it before, but is there something about someone you're looking into their past and they own a ton of property, and maybe they're stretched too thin?
Yeah, sure. We look at that, but generally, our principals, they have pretty broad support teams. So it's not just one individual who is managing these properties, administering, dealing with investors. We work with the team. So obviously led by a senior manager that is making those decisions on what properties to acquire, and maybe dealing specifically with some of the larger tenants for commercial properties. But typically, our clients, they have a lot of administrative and support staff to help them.
Okay. The other question I have, just kind of on getting back a little bit to the accredited versus unaccredited. Now, if someone was an unaccredited investor, is there a mechanism? Let's say you had 10 investors who were all considered unaccredited. Is there a way for them to form any type of LLC or entity where that LLC or the entity could become an accredited investor due to kind of it's kind of like the crowdfunding allows people that are accredited to put small sums of money into a larger project. Is there any way for unaccredited investors to work their way together to become an accredited investor?
That's a great question, and the SEC thought about that. So the definition of an accredited investor expands beyond just the individual, what I cover. It also covers how entities are accredited. And so one of the rules is if you have an LLC, you have to look through to all of the equity owners of that LLC to make sure that those individuals are accredited.
So each member of the LLC has to be accredited.
Yes. So a group of unaccredited investors can't pull together and have that $1 million in net worth or have the income. Yeah, you can't do that.
And what about spouses? If there was, say, the one spouse was accredited, is there any rule regarding, like, let's say, you have one spouse is accredited, they want to make the investment, their spouse also wants to, but that spouse is not individually accredited, or is accreditation for a married couple kind of considering both of their assets?
So as long as at least one of the individuals makes $200 or the income combined is $300, they're deemed accredited.
Okay.
So if you have one spouse that makes $200 and change and the other spouse makes nothing, they're accredited. The individual is accredited. If you have two spouses that each make $150, together they meet the definition and reach that $300 hurdle. Okay.
Well, I don't see any other questions at this point, Heather, from the people who attended. Like I said, we've recorded this, so we'll be sending this out to. Actually, of course, a question popped up right as I said that. But it says, does the funding circle make investor loans on real estate?
I don't think Funding Circle participates in real estate. I think they focus more on early stage and mid stage companies in the growth space.
Okay. Again, I want to thank you again for joining us. We recorded the webinar. We'll be posting on our site and sending it out to our contacts as well. So if anybody who's listening to a recording of this presentation, here's the information on Heather's to reach Heather and get your questions answered. If you had something directly you wanted to ask her about an investment, due diligence, anything that was covered or maybe even not covered in this webinar, please reach out to her here. Thank you again, Heather, for joining us. I thank everybody for participating, and we'll look forward to talking with you in the future.
Thank you. Have a great day.
Thanks. Bye-bye.